Sorry. Nervousness. Hello everyone. We do it again. Warmly welcome to Kulturhuset Stadsteatern and to this seminar on a directive called The Framework for the Recovery and Resolution of Insurance and Reinsurance Undertakings. In daily parlance, EU parlance, IRRD. My name is Claes Jansson and I am the acting head of the European Parliament office here in Sweden. And we are very happy to organize this event in close collaboration with Folksam, Fungera and Länsförsäkringar, and with the support of Amice. Soon, we will only have 1 year left until the next European elections, who will take place in all the EU member states on the 6th to the 9th of June in 2024. And the IRRD is only one of the many important pieces of legislation that need to be concluded during this legislature. I hope we can come back on the elections at numerous occasions this and next year in order to discuss the importance of European democracy in action, with IRD as one of the examples. And as we have a very packed program today, I will soon give the floor to today's very experienced moderator, Professor Kalle van Hulle. Kalle van Hulle lectures at the Economics and Business Faculty of the Katholieke Universiteit in Leuven and at the Economics Faculty of the Goethe University in Frankfurt, where he is attached to the International Center for Insurance Regulation. Furthermore, he is a member of the Public Interest Oversight Board and of the board of the Bermuda Monetary Authority. He served as head of the Insurance and Pensions Division at the European Commission until 2013, where he was responsible for the development of the Solvency II directive. Dear Karel, we met yesterday evening, and it was a very nice evening. You immediately demonstrated your deep knowledge of the subject matter, and as well as some interesting and humorous stories and insights from your period in the European Commission. I learned a lot from that, things I never heard about before, and I hope we can go on like that, learning new things. And dear Kalle, the floor is yours. Welcome.
Thank you. Thank you very much, Klaas, and good afternoon, ladies and gentlemen. It feels a little bit strange for me to be on the scene in a movie theater, but I will start by disappointing you. The light will stay on, so we will see when you're not listening. So, indeed, as Klaas indicated, I'm a retired official of the European Commission and was responsible for the development of the new solvency regime for insurance and reinsurance undertakings called Solvency II. I wrote a book about it, which of course I recommend you to read, which has the appealing title, Solvency II is good for you. And if you read it, you will agree with me. The new regime applies since 2016 to all European EEA, insurers and reinsurance. But although it is a risk-based regime, which is different from Solvency I, which was only partly risk-based, this is a fully risk-based regime. Although it is that, there is no guarantee, ladies and gentlemen. It was not designed as a zero-failure regime. This means that it is accepted. It was accepted by the co-legislators, by all the member states concerned, by all the stakeholders, that although we have this regime, it would still be possible for the insurer to fail. As you know, there is no absolute certainty in life. Actually, there's only two certainties that I believe we all face. And that is, we will all die at some stage. And we will all pay taxes until we die. So besides these certainties, I think we live and continue to live in an uncertain world. Now, Solvency II has helped insurers to remain solvent. And indeed, the regime has worked well and allowed the insurance industry to withstand important challenges. As you will remember, the pandemic, the low interest rate environment. We're almost nervous with the high interest rate environment we're living in now. As you see, things are changing. And of course, also the impact of climate change, where the insurers faced more natural catastrophes, more severe natural catastrophes, but Solvency II allowed the insurance industry to meet these important challenges. However, the financial crisis, 2008-2009, showed us that we need to remain vigilant and that prevention is better than remediation. That was the reason that for banks, a crisis prevention framework was adopted in 2014, called the Banking Recovery and Resolution Directive. And we are very pleased to see that the rapporteur of this directive is with us today. As the saying goes, you may not like it, what is good for banks should also be good for insurers. That's at least what the banking regulators say. And often thereby forgetting the particularities of the insurance business model. For instance, in the case of a banking crisis, as we have seen recently in the United States and in Switzerland, action needs to be taken yesterday. When we have a crisis in insurance, there is time to deal with the consequences of the crisis. So that is a difference because of differences in business models. But nevertheless, pressure has been exercised on the European Commission since 2015 by the European Systemic Risk Board and by EIOPA to enhance Solvency II with a crisis prevention framework, including a framework for recovery and resolution of insurers, ideally combined with an insurance guarantee system regime, so as to be fully mirror what exists in banking. And that's the reason why the Commission presented in September 2021, as part of the first review of Solvency II, a proposal for a new framework for recovery and resolution for insurers. It's fair to say that not everybody welcomed the Commission's proposal for a directive on recovery and resolution for insurers, the so-called IRRD. Some people feel that this is killing a mouse with an elephant. Should all insurers apply this complex recovery and resolution framework when only few insurers fail? And actually the calculations show that on the average about 10 insurers will fail during any given year. This is the reason why much of the debate about the IRRD has also been concentrated on the question which part of the insurance market can or should be covered by this new regime. On the other hand, it is argued that insurance failures can have nasty consequences for policyholders, particularly in a cross-border context. And that the failure of a large insurer or a simultaneous failure of a number of insurers can have an impact on financial stability. And finally, it is also said that EU action is needed because there's 3 member states that already introduced such a regime. There is France, Romania, and the Netherlands. The debate on the IRRD in the Council was concluded under the Czech presidency last year. Discussions in the European Parliament and particularly in the Economic and Monetary Committee are still ongoing. Eventually, both co-legislators need to agree on the same text. And ladies and gentlemen, this is not evident. And this will be part, most likely no longer under the Swedish presidency, but this will be under the Spanish presidency, will be part of what we call in Brussels the trilogue. This is not Shakespearean English. It does not exist in English, the word, but a trilogue is a meeting between the Council that has its position, the European Parliament that has its position, and the Commission is sort of sandwiched in between. A trilogue is actually a sort of organized war between the 3 institutions. I had the privilege of being part of some of those, and when I have gray hair, it's one of the reasons why that is the case. Today, we will focus on the possible impact of this IRRD on the mutual sector, with special attention for the Swedish mutual sector. As you know, mutuals play an important role in the insurance markets all over Europe, in many member states, and particularly in Sweden. It is therefore important that this new crisis prevention regime takes account of the particularities of the mutual legal form. Proportionality could be helpful in this regard. This is the approach that we took under Solvency II, whereby we refer to the nature of the insurance business, which also covers the legal form. As to the program of this afternoon, we will first start by listening to the views of Johan Hedberg from the Swedish Ministry of Finance, who will tell us what happened in this area during the negotiations in the Council. We will then turn from the Council to the European Parliament and have the testimony of a number of members of the Parliament on video who are members of ECON, including or substitute members, including the views, very importantly, of the rapporteur, Markus Ferber. After that, we will have an interview with Lars Hallkvist and from Landsverzekering and Ilva Wessen from Volkswagen, who will inform us about how the IRRD might affect their important mutual insurance groups. Following this interview, we will have a short presentation by a representative of Amice, the Insurance Association of Mutual Insurance and Insurance Cooperatives in Europe, Belma Jesarove, who is representing here Amice. Unfortunately, the president could not make it for personal reasons, but thank you, Belma, for taking up this post. We will conclude this afternoon with a panel discussion including Gunnar Hökmark, former MEP, Hanna Wallinder, representing the Insurance Trade Union, Forena, and Jonas Söderberg, representing Insurance Sweden. That is the movie for this afternoon, ladies and gentlemen. And it is important that we use the opportunity to listen to the experts, to listen to the actors on the field, to better understand what are the issues, what is the relevance for the mutual sector, so that we can all go home after this event by educated at a higher level. So, without further ado, I would like to call now to the floor Johan Hedberg from the Ministry of Finance, who is one of the actors in the field. Johan, you have the floor.
Thank you very much for welcoming me, Carl von Holle, and thank you all for coming today. I'll try to sort of give an introduction to the work we have done on IRRD in the Ministry of Finance. My role has been to be the head of delegation during the Council negotiations on IRRD in Brussels. This presentation might, I mean, we're the acting presidents now of the European Council, and we're, as always, bureaucrats. So I'm not a politician, so I'm just sort of, it will be slightly bureaucratic touch to this presentation, which it means that I will focus on sort of the what has been said and what is on the public record from the Swedish government on IRRD. So that's the sort of I'll just make that bit of a remark before starting. Anyhow, see if I can manage this technology here. All right, this is all sort of stating the obvious for all of you, obviously, but we have these three insurance files which are under negotiation in Brussels at the moment. As Mr. van Holle has already told you, not much has happened with the first two during our presidency, Solvency II and IRRD. Solvency II, we had our French colleagues, which managed to reach successfully a general approach in the Council in June last year. And since then, there has been a waiting for the European Parliament to reach its position on this file. So it's quite a long time now. On IRD, we have a similar situation since December last year, when our Czech colleagues managed to conclude and reach sort of a compromise, not a general approach, but a sort of negotiating mandate for further negotiations with the European Parliament. And I'm just going to put it there. RIS is the retail investment strategy, obviously, which the Commission presented its proposal yesterday. I'm not going to speak about that very much, but those negotiations will start now. But obviously, since we were only a bit more than a month left of the Swedish presidency, the bulk of the work will have to be done by others after us. All right. What about IRD and the Swedish sort of how from the Swedish government what has the Swedish government and the Swedish Parliament as well? What views have those sort of government bodies in Sweden taken on IRD? Important to remember that we don't have a similar framework in place today in Sweden, unlike the Netherlands, France, Romania, partly also I think Greece, those countries which have a recovery and resolution framework in some form, a crisis management framework for resolution and for insurance undertakings. We don't have that in Sweden. We have been quite fortunate, I would say, listening to other European colleagues in the sense that we have had very few insurance failures. So maybe there has been sort of a challenge to see what is the use of this framework. I mean, just starting from that fact that we don't have this on the statute books today, and we have been quite fortunate compared to other countries when it comes to insurance failures. There was a memorandum which was submitted to the Swedish Parliament in the autumn of 2021, in Swedish faktapromemoria, fact memorandum, which is the job of the Swedish government to sort of tell Parliament what it thinks and check whether Parliament agrees with that position that the Swedish government took. So, and in that memorandum, there are some points which could be teased out here. And it's stressed there that there needs to be a cost-benefit balance. Any benefits must sort of outweigh the costs. That's sort of a Swedish position. There should be proportionality, sort of a risk-based approach, more or less, you could say. There should be flexibility for resolution authorities when deciding which undertakings should be put under resolution, or the sort of a concrete strategy which is chosen for each undertaking. And also, important point for this seminar, the last one, that attention should be paid to the legal form of undertakings, and mutual, not least, of course, mutual insurance undertakings. And going further a bit on that particular subject, I mean, that is a very important matter here in Sweden that Professor van Hull has already mentioned, that the mutual sector here is quite big when compared to other European member states of the European Union. So it's important from a Swedish perspective that there is a sort of that this sector is treated well in this new framework. And there was a need we saw for some adjustments. So there was a non-paper which was submitted from the Finance Ministry in February 2022, which dealt with this issue of sort of opening up for a more tailored approach towards the mutual sector within the IRRD. When looking specifically at the resolution tools, that is familiar to most of you here, but those are the concrete actions that the resolution authority tasked with applying this framework would take in a crisis situation. Among them, you can mention sort of a write-down is one of the tools that is mentioned, sort of writing down liabilities. You have the transfer of business tool. There is the bridge undertaking to the quite specific tools, which, well, it's quite easy to see how they would be applied to a shareholding undertaking, but rather more difficult to see how they would be applied to an undertaking where sort of the policyholders are also the owners, have this dual function within in a mutual setting. So we had this proposal where which would open up for member states to introduce their own tools when the tools provided for in IRRD would not fit in the mind of that member state. The member state would be allowed to introduce tailored tools, or sort of which are specifically adapted for the concrete legal form of that undertaking. And we're happy to see that this proposal has made its way into the Council compromise, just putting it there, Article 26.8 of the Council compromise, which more or less says the same thing. It's been a bit more explicit there, that it has to do with mutual undertakings. Mutual undertakings are mentioned specifically in the text of the Council compromise. So that has been an important matter during the negotiations, and I think we don't know what the position of the European Parliament will be. We know that there has been some amendments tabled in the European Parliament, which deals also with the issue of mutual undertakings, but we will see how that plays out in due course. So that was my few short words.
Excellent. Thank you so much, Johan, for your insight in what has happened in the Council. And I think without further ado, we will pass on to the Parliament. We mentioned the Parliament. And we are going to see first an interview with the rapporteur on this file, who is Markus Ferber. And he always holds strong views, as you will see from the video. So if you could please play this first video. I don't know where it's going to appear.
Dear ladies and gentlemen, first of all, I would like to apologize for not being with you in Stockholm today, as my commitments as a member of the European Parliament are keeping me in Brussels. I believe it is fair to say that for most people the IRRD file came as a bit of a surprise. We are all expecting a substantial review of Solvency II. This had absorbed all of the oxygen, and so the IRRD proposal flew a little under the radar. To be quite honest, I'm still not 100% convinced that we actually need a dedicated resolution framework for insurance undertakings. While we were recently reminded once again that the risk of a bank run is a very real thing and something that one should plan for, the same is not true for insurance undertakings. Insurance undertakings have long-term assets and long-term liabilities. Unlike in the banking sector, there is no inherent maturity mismatch in the insurance business. Therefore, it is not obvious that we need to transpose the regime we have in place for banks and central counterparties into the insurance world. That being said, the proposal is on the table and the co-legislators have started the work. In fact, EU member states have already concluded their deliberations, and in the European Parliament we are also inching closer to an agreement. The most controversial topics in the deliberations so far have been the question of resolution funding, how to deal with insurance guarantee schemes, and the question of exemptions. Given my skepticism towards the proposal in general, I have always argued for a moderate and principle-based approach that does not overburden the insurance sector with excessive new requirements. For the question of resolution funding, that means that I do not see a need for a dedicated resolution fund that many of my colleagues argue in favor of. This idea is not in the Commission proposal, and that is for a good reason. Unlike in the banking sector, an insurance company does not need to be wound up over a weekend. Even if an insurance company fails, it tends to happen in slow motion, so there is no need to keep a giant pot of money ready. Regarding insurance guarantee schemes, There are some colleagues who view the IRD proposal as an opportunity to introduce a complete new regime for mandatory insurance guarantee schemes in all EU member states. It is true that the protection policyholders enjoy various considerable across member states, and there is a need for some level of minimum standards. However, I do not think the IRD is the right place for this. Such a proposal would require intensive preparation and an in-depth impact assessment by the European Commission and, of course, by EIOPA. We can task the Commission and EIOPA to start the preparatory work, but should not get further in the IRD. One of the big points was the question of exemptions or a special regime for mutuals or cooperative insurance companies, which I know is of particular importance to you. As a general rule, I firmly believe that regulation should not lead to structural changes in the market and that we need flexible solutions to achieve that. In my first set of compromises, I have therefore proposed to exclude mutuals from the scope. However, to be completely honest with you, there was no support in the European Parliament for a full exclusion of mutuals, which I find very regrettable. I will keep working on finding reasonable, proportional and pragmatic solutions that work for all types of insurance undertakings. This is in very short words, of course, where we stand at the moment. I wish you all the best from Brussels, and I hope that you have a productive seminar in Stockholm. Thank you very much.
Thank you, Mr. Ferber. Ladies and gentlemen, as you can see, this is the rapporteur. He's a very important person who has to try to gather the compromise in the committee, which will then lead to the position of the Parliament. Maybe important things to retain for you is, first of all, that he is not supportive of the ideas to have a resolution fund created in this context. It's very important. The Commission did not propose that for obvious reasons, same reason that he indicated. But also the fact that the idea of excluding all the mutuals from the scope is unlikely to be adopted by the Parliament. So another solution will be found, and he is willing to look for proportionate solutions. I think that's important to keep that in mind as his messages to you. So let's now continue and listen to another member of the Parliament, Stéphanie Ion-Courtin, also a very active member of ECO.
Dear listeners, I first like to thank the organizers of this event for inviting me to contribute to your seminar today. I am happy to address Karel van Hulle's questions on IRRD, the famous Insurance Recovery and Resolution Directive. This is a file for which I am negotiator on behalf of my group, Renew Europe, in the European Parliament. Where are we now in the European Parliament's negotiations? Few, although quite important topics remain open. The issue of scope and the resolution financing, for example. For me and for my group, it's crucial to set the right criteria when it comes to the scope of application and to put in place safeguards protecting the interest of policyholders in recovery and resolution processes. When it comes to financing arrangements, it's necessary to have an external financing to avoid that policyholders become primary financiers of a resolution. As we move closer to the finish line, a key topic that will need to be addressed is the issue of coherence between the two texts that form together the so-called insurance package. IRRD and the revision of the Solvency Directive are negotiated in parallel, and it's no secret that there are many interlinkages. my group and I personally could not agree more on the need to ensure proportionality in the text. We cannot apply the same rules to different types of companies. Measures need to be tailored to these specificities. First, no company is shielded from having financial trouble, so it's very important that the directive covers most of them for the sake of consumer protection. But small companies, take mutuals, for example, would be overburdened if they fall under the same regime as multinationals. For SMEs especially, my group aims to ensure they are exempted from the scope of the directive, or that simplified measures apply to them when necessary. Second, as you pointed out, member states' companies have different legal forms. All companies must abide by the same rules. However, the directive ensures that measures are adapted, if necessary, to the legal form of the said company. Those elements are there to protect the diversity of companies in member states in terms of size of legal forms. Harmonization is about setting a benchmark, putting in place common standards for regulators and companies to be better prepared in times of crisis. It's not about unifying the rules. Each member state and companies will preserve their specificities. So common standards will, one, incentivize companies to pursue activities in more than one member state if they wish to do so. How? By ensuring a level playing field, reducing red tape and making cross-border activities easier. Two, they will better protect our citizens from failing insurers, and this will only strengthen our European markets while preserving national specificities, and this is what our single market is all about.
Thank you, Stephanie. Again, a different message. This is a different group in the European Parliament. Of course, they will have to agree between themselves, but important elements is also that you can see that she is very much supportive of the idea that EU legislation should not kill existing structures in different markets, so that account must be taken of the diversity, of the particularity, specificities of the local markets. And I think that is certainly a very important point in the discussions going forward. Now, closer to home, a Swedish MEP. Jessica, I will not pronounce her name correctly, I know, Polfjord, is that okay? Oh, thank you so much. So, Jessica, you have the floor.
Some of the main goals should be to avoid unintended consequences, as well as making sure that there's an actual problem to be solved. And that goes for any legislation. We shouldn't run around to try to find nails where we can use or hammer. I think the hammer in this case, IRRD, was an excellent tool for solving the risks and challenges in the European banking sector. It is not certain, however, that we can simply copy and paste this to another sector that is in many ways in a different area. And from a Swedish perspective, our sectors would and will be affected. For instance, a big share of the industry consists of mutual insurance undertakings. Thus, our market looks different compared to other countries. And how they should implement several parts of the proposal when their owners are also their clients is unclear, to put it mildly. And using a risk-based assessment would have made more sense. I would say taking factors such as size, business model, risk profile, and cross-country activity, that would have been taken into account, and I think that have been right and a more responsible approach. I think a lot of that can be summarized in the amendments I tabled in the European Parliament. First of all, we have to realize that the insurance markets in Europe are quite different in several aspects. Risk for financial stability, market concentration and types of business. The conclusion one should draw from this is that we should allow for quite a big degree of flexibility for member states.
Okay, well, that's again an interesting message. Very important what she said, avoid unintended consequences. And it's interesting to see that the European Commission took as a basis for recovery and resolution in insurance the BRRD. Why did the Commission do that? Because that exists. And the question is, what needs to be changed? If the Commission had chosen a different approach, everybody would have criticized the Commission. Why do you find something completely different when you already had a BRRD? So that's always difficult to do right. But again, important, no copy of paste or paste of the BRRD, so recognize the specificities of insurance. The last person, MEP, we are going to listen to is Ilan de Basso, who will also answer the same questions, but maybe give different answers. Let's listen.
Dear friends, thank you for the opportunity to participate digitally in your seminar. You have an important and interesting agenda ahead of you, and I would love to be with you in Stockholm, but today I really need to be in Brussels for committee meetings and votes. My work in the Parliament concerns many different issues. Regardless of how different the questions are, my work is always guided by the principles that the European Union needs to be relevant in the everyday lives of our citizens and the challenges that no individual member state can tackle on its own. When working with the European legislation, we need to make sure that the proposals are proportionate, accurate, and that they don't have any unintended consequences. We often see proposals from the Commission that may have good intentions, but are designed in a way that risks threaten activities and principles that have worked for a very long time. The Insurance Recovery and Resolution Directive is such a proposal, where the overall objective is important and relevant, but there is a need for a better understanding of how this would affect certain organizations, in this case, mutual insurance companies. Frameworks for resolutions are important to safeguard the stability of financial markets and protect taxpayers from having to pick up the tab if investors act irresponsibly. But such regulation also needs to take into account the differences between member states and allow flexibility. We want to see a regulatory framework that both ensures the stability of the European insurance market and protects the interests of Swedish pension savers and policyholders. That is what we are working for in the Parliament and what the Social Democrats advocated for negotiations as the Swedish government. As you know, the negotiations are ongoing and many of us have important roles to play in the continued work on the directive. The position often needs to be repeated again and again, and I know that you are actively participating in the discussion on this, not least with this seminar. With that, my friends, I would like to wish you a good event discussions. I hope that we'll have the chance to meet in person in the future, but until then, please feel free to contact me and my colleagues here at the Parliament. Thank you.
Thank you, Ilan. Well, that was the last member of European Parliament for today. You heard different political groups, quite interesting to see these perspectives, but some commonalities here again, flexibility, avoid unintended consequences. These are big words, but to translate that into language that is workable, that's the challenge. Now, we've discussed now IRRD, we've talked about mutuals, but we haven't yet seen a representative of a mutual on stage. And that is why I would like to invite now Lars Hallkvist from Landsverzekering and Ilva Wessen from Volksam Group to join me here on stage to discuss mutuals. Please, lady first, and gentlemen, take place in the middle maybe, then I don't feel so lonesome on my seat here. And maybe in order to start our discussion, it would be interesting, and if I may start with you, Ylva, to present your group. I know you're very well known, but there are people here who are not from Sweden, and maybe they don't know you.
No, I'm happy to do that. Thank you.
You're welcome.
Yes, I'm the CEO of Folksam, and Folksam is an insurance company and pension savings company founded in 1908 in Sweden. We insure over 3 million households in Sweden, which means that we have 2/3 of all households in Sweden insured by us. We have around 50 billion euros under capital management on behalf of our customers, which means that we are one of the leading players in Sweden, both in insurance and as a pension savings. And talking about mutuals and our solvency ratio in Folksam Life was 185 by the end of 2022, and the consolidation ratio at Folksam General was 187 by the end of 2022.
Which is very good, by the way.
It is.
Yes.
Yes. That was Folksam in short.
Okay, so that's important. By all means, you are a big group. So when we talk about exclusion of small companies, certainly not your cup of tea.
No, that's correct.
I think you are a very important player, and that's important to know. And let's now turn to you. Can you present your group? And
well, Länsförsäkringar is a little bit different, I would say. As you know, it consists of 23 small to medium-sized local mutuals across Sweden that cooperate in a way with a common brand and also in certain products, but based on independent mutuals, very close to their owners and policyholders. And they've been there for some in more than 200 years, some a few years less. But one could say that it's a success story since at least from the middle of the 20th century when it took speed and we moved from the countryside into the cities and started to insure not only farmers but private persons, small companies and so on.
You are a very important group, and that's the reason why I cited you in a footnote in my book as one of the big mutuals in Europe, because the contribution of the mutuals to society in general, I think, is well recognized. And I'd like to hear a little bit more from you on what specific, how would you describe, what is your contribution in Sweden, obviously, because that's where you operate, which may be different from what other insurers are doing. So what is now, starting maybe again with Folksam, how would you convey that message to the audience?
Well, first of all, we do everything that a limited company, as a limited insurance company, does as well. But apart from that, for example, just to give you two examples what we have done in Folksam. Recently, we distributed 3 billion Swedish crowns in cash to our customers. And that was from Folksam Life. And that was above what we give them in return on their savings. 3 billion in cash. Just because we are mutual and all surplus should go back to our customers. Folksam General this year gives back 1 billion Swedish crowns to our customers. For the same reason, all surplus should go back to our customers.
And do you get a response from your customers, a positive response?
If you distribute 3 billion and plus 1 billion, yes.
Good. Yeah, but sometimes people don't respond. They just take it for granted.
No. Well, of course, they are grateful and see that we act in a responsible way, being mutual. That's the financial side of it. talking about contribution to society, I would say something that stands out for us as mutuals are that we contribute to a sustainable society. And decades before others got engaged in sustainability, we were active. In the 70s, we started our own research department to improve road safety. And today we offer eco-labeled home insurance and work with circularity. For example, we repair mobile phones, we recycle spare parts from our damaged cars, and I think we go beyond what you can see a limited company does. I would say that the mutual legal form is fantastic and has the future ahead of it if we get the same conditions from the legislator as the limited companies. What we see today, we struggle with disadvantages because the legislator doesn't really understand the mutual form.
Can you give an example of that?
I think we just heard Stephanie saying that mutuals are small companies. We are not.
No. Thank you. Please, Landsverzekering, the same.
Yes.
How do you do? Yeah, please.
Yes. I would say that our very long history shows that we are both sustainable and resilient. I would say 200 years in business is impressive. But the key words actually is in a mutual, in the Länsförsäkringsbolag, is participation and democracy. Mm. We are very close to our customers and owners, and we have a demand from them to be resilient, and we can do that. We can be that just because we don't have any other stakeholders than the owners and the policyholders. So what is expected from us, which are usually higher because we are a mutual company, can be achieved just because we don't have any other than the customer itself. And therefore we can take part in the local society in many ways, both in our business, but also besides our business, to make a more resilient society. And that varies from all over these 23 companies in many ways. In activities for sustainability, but also getting the society together, which is a big thing ahead of us.
Do you get a positive response from your members by doing that?
Yes, very much so, and we are expected to do it.
Okay, very good.
So, and we have the possibility to do this.
If we can now turn a little bit to the subject of today, recovery and resolution. The question was asked to the MEPs, what they think about this. What do you think about it? Is there a need to have such a regime for the protection of your policyholders that are at the same time your owners?
If I may start?
Yeah, please.
Thank you.
Yeah, I will follow the same order if I may.
We heard from the rapporteur in the European Parliament, Markus Ferber, that he has strong doubts whether IRRD is actually needed, and we understand his doubts. And we, the Nordic insurers, object against IRRD since we see no need for it from a Nordic perspective, not for the financial stability in the Nordics, nor for the protection of the Nordic policyholders. And as you said, that Solvency II is good for you.
Thank you.
I absolutely agree. And Solvency II is a regulation that works very well for us. And combined with national legislation that provides sufficient safeguards. The proposed IRRD seems to be based on beliefs that insurance companies have a significant impact on financial stability. This is a misconception. Nordic and other EU insurance companies played no part in the global financial crisis in 2008-2009. And instead, the insurers rather contribute to the stability of the financial systems, both during the financial crisis and also during the pandemic, the COVID pandemic we just recently seen. Insurance companies supported the financial systems during these periods. And that's a big difference from banks.
Can I still play the devil's advocate, if I may?
Sure.
What would happen if something happened to Folksam?
Well, of course there would be a significant impact of policyholders and society.
Yes.
But since our business is well managed, I may say, there will be a lot of our competitors today that would be willing to take over our policyholders. And as you already mentioned, this doesn't need to be done overnight. And since we run our business under Solvency II, I mean, there are so many thresholds that need to be passed before we would even be in a situation where we would need to hand over our policyholders to Länsförsäkringar.
Okay, very good. So what is important as a message is that you have been thinking about this.
Definitely.
Okay, because sometimes one has the impression that people believe you never think about it, but you do think about it.
We are in the insurance business.
Very good.
Everything we think about is risk and how to avoid it.
Excellent.
And we've been around for 100 years, more than 100 years, Folksam, more than 200 years, Länsförsäkringar.
Yeah.
I mean, our ambition, if I may speak for both of us, are to be around for the next coming 100 and 200 years as well.
Well, good luck to you. Lars,
Yes.
I presume you pretty much share the...
Yes,
the
I
same
do.
view.
I do. And I would say that if Solvency II is good for you, it's good for us.
Thank
So,
you.
and we think that Solvency II is pretty much what we need. We don't need any more frameworks in this field. And as Dr. Ferber said, that he's not convinced that there is a need for this framework. And we agree upon that, really. I would also say that one should not put recovery and resolution in one box, so to speak. It's two different things. And recovery is already taken care of in the Solvency II legislation. We do the ORSA every year.
ORSA, yes.
Yes. Resolution is very much depending on what kind of legal entity it's applied on. It's quite different. So I would say that it's very important that you put these two things apart.
Yeah.
And that when thinking about resolution and thinking about the process of resolution, that you apply it on different kind of entities and see what happens, you know. And you will see that it's quite different what happens.
Yeah.
So that's basically our opinion. I would also say that you know, if all entities were the same, that would be very risky on the market. You know, having mutuals, limited companies, maybe other legal entities makes it more sustainable.
Yes.
So that should be encouraged, really, and not worked against.
Yeah. In fact, unity in diversity, that's a little bit the motto of the European Union, and that's exactly what you're saying. But we now have this proposal. And the question is, and that's a very relevant question, what would you believe, and I start again with you, Ilva, what would you think could be the potential consequences for your group if this directive were to be adopted and imposed on you, recovery plans, resolution plan with the tools and the actions from the resolution authority? How would it affect your group?
It would affect us heavily. And I would say that the most difficult part to tackle is the dual role of our policyholders and owners. Our policyholders are, of course, protected by us, but they are also the ones that should be providing risk capital. And our policyholders are most likely individuals like you and me. And providing risk capital to a business that insure 2/3 of every household in Sweden and 50 billion euros capital under management, it will be hard to convince them to do that. I would say that speaks for itself about the challenge that we will have. So the most important thing for us now, since we do understand that it will be hard to have all mutuals not covered by the IRRD, is that the national legislations can be flexible to adapt the legislation to suit mutuals in Sweden and in other countries. This is needed.
Okay, good. That's a clear message. I think that some of the MEPs agree with you, so good for you, Lars. What would be the impact for Lars Försäkring?
Well, since it consists of 23 companies, it will have different impact on these 23, I would say. But we are talking about small companies to very small companies. And I would say it would have an enormous impact even on the small ones, not to talk about the very small ones. It will be also quite unfair to the policyholders, which are the owners, compared to owners of other insurance companies. So it will make the market quite unfair.
Would you think that your owners, your policyholders, if such a piece of legislation were to be introduced, would scare away from insuring themselves with Lars Försäkring?
Well, if it's not as attractive as it is right now, a customer or a policyholder would, move to another company, of course. So it will affect the competition between small and big companies, between mutual and non-mutuals. And it won't affect them only as a policyholder, but also as owner.
Yes, obviously, yes. Yeah.
So it has two effects.
Yeah. Now that being said, and that is my last question, which is an obvious one, we have the proposal. We see the risks. Now you have this unique opportunity to give a message to the co-legislators. What do you want should be done? Ylva.
Ladies and gentlemen, what we would like to see is that we hope that the co-legislators will provide sufficient adaptations of the IRRD proposal so that member states in their turn are able to adapt certain parts of IRRD nationally to suit the mutuals in Sweden and in other countries. On the Council, we welcome that the Council, in its general agreement on IRRD, gave flexibility to member states so that resolution authorities can adapt the resolution tools if they are not applicable to an undertaking due to its legal form. We know and appreciate that the Swedish government was early in raising possible solutions that would allow for adaptations to mutuals in the Council discussions. And on the European Parliament, we were encouraged by several amendments tabled by the members of the European Parliament to handle some of the feared consequences. And finally, I would say, I have a dream. I have a dream of legislators saying, oh yes, in all drafting of new legislations, we ensure that the legislations also works for mutuals where the customers are covered by the risk at the same time as they are responsible for the risk capital. Thank you.
Well, that is a very nice dream. I hope it will come true. It's obviously very difficult in legislation to take care of everything, but I think that your message about flexibility, adaptation, I think that's a clear message, and that should not be technically impossible to carry out. Very good. Lars?
Well, I would say that I would really wish that there was a better knowledge in different legal entities, especially about the mutual entity. That would, if with that knowledge, this work will be done properly, I'm sure. To consider that there are different entities and their market position. So with that knowledge, I have much trust in that this will be very well performed work.
Okay, trust is important, but knowledge, of course, is also important. And I do remember from my own experience when we were negotiating Solvency II, I had the privilege of knowing the mutual sector and the cooperatives very well, because my father was very active in that movement. And I wrote a book with him about cooperatives. So I knew very well your particular problems. And that allowed me to take part in these proposals, which in the Solvency II directive recognize the existence of mutual, in particular your capital position, the surplus funds, to name something. This is very important. So I think my message to you is make sure that the lack of knowledge, which is definitely there, is replaced by knowledge. And as you know yourselves better than anybody else, I think there is a task for the mutual sector to make sure that in Brussels, in Strasbourg, whatever, that the co-legislators are aware of the particularities of your sector. And if you take that with I would say a positive view, a positive message, I think you will certainly find acceptance also for your arguments. That's what I wish. I hope that will be a dream. Ladies and gentlemen, let's thank the two persons here represent the mutual sector in Sweden, and let's hope that their dreams come true.
Okay. Thank you very much.
Thank you. So now we will move from Sweden to Europe again. And Sweden, of course, is part of Europe. But we use the more European perspective. And unfortunately, as I mentioned before, the president of Amice could not be with us today. But we have here a good representative from Amice who will take this position and explain a little bit the role of Amice and of the mutual sector from a European perspective. Please, you have the floor.
Thank you. Thanks. So, as it was mentioned earlier, I'm here on behalf of Grzegorz Buczkowski, who unfortunately couldn't make it today, and he sends his deepest apologies, but wishes everyone a very successful and informative seminar. And on his behalf and on behalf of Amice, I will try to make few observations. We already heard the views from the Council, the members of the European Parliament, the Swedish perspective, and now I'll try to share our expectations from the European perspective of the insurance sector, and in particular the mutual and cooperative insurance sector. But first of all, for those of you who don't know Amice, we are the representative organization for the mutual and cooperative insurance sector, and we represent members in 21 countries across Europe. Our members are policyholder and society focused in their activities, and they are active participants in Europe's social economy, focusing on their policyholders' needs and on the sustainability agenda, which emanates from that perspective. In terms of figures, approximately half of the insurance firms in Europe are mutuals or cooperative in their structure. They write between them approximately 505 billion euros in insurance premiums in 2021, and they represent a a European market share of approximately 32%. Now, mutual and cooperative insurers and other forms of non-listed insurers deliver many benefits to European consumers in terms of dynamic market diversity, but also competition and customer accountability. All of this is underpinned by their unique structure in that they pursue a corporate purpose which is distinctly different from the stockholder-owned companies. Mutual and cooperative insurance is provided by societies that are formed and governed in the majority of cases, owned by their members and for their members. Now, moving on to the IRRD discussion, Amici has been following closely the development of the proposal of the Insurance Recovery and Resolution Directive, and we've been assessing the potential impact of this proposal on our members and on their policyholders, and we've been also actively engaging in the discussions together with the European co-legislators. I was actually recently, a few weeks ago, in Stockholm, and I attended a conference, one of the largest conferences on European financial regulation. And there was a very interesting speech which was made by the governor of Banque de France, François Villeroy de Gueulot. So his speech was entitled Three Blessings and a Funeral. Sorry. So too many funerals, and this was in the context of the current, recent banking turmoil. And I guess you can probably guess the name of the funeral that he was referring to. But I would like to share maybe the three blessings. So, regulation, supervision, and resolution. Now, if we look at regulation in an insurance context, we already mentioned we have a quite robust framework, the Solvency II directive, which proved to work well, and now we have some fine-tuning that's happening as part of the Solvency II package. So it's a good framework, and we haven't seen many failures since the application of the Solvency II. Now, the second point is supervision, and I think even if we have good regulation, sometimes good regulation is not sufficient, and we really need to make sure that the regulation is enforced appropriately. And here comes the effective supervision. And if we have effective supervision, we are likely to see less failures. And then the third point is resolution. And here, I think it's very important to bear in mind that resolution is a last resort measure, so it's not to be used on a constant basis, and it should be put in this wider context of, we have a Solvency II framework and we need to have an effective supervision. But how can we make it work? And I'll share now three main points and our expectations on how we can improve the current text. First of all, I think it was mentioned already, but we believe from our perspective that the IRRD should better consider the mutual legal form. And this is for several reasons. Like, the mutual legal form is quite vital component of the wider European insurance market. It provides diversity of form, choice to policyholders, and a long-term perspective, which is not afforded to listed insurers. So those characteristics provide economic stability, wholly policyholder focus protection, and a balanced and extended time horizon, reflected in their particularly strong solvency ratios. Their ownership is by their members, policyholders, and their aims are this policyholders' best interest. Such legal forms, where the policyholders are the owners and there are no external shareholders, are currently not reflected in the proposed legislation, despite the fact that they're responsible for almost 1/3 of all insurance transactions in the EU. Now, by not recognizing the mutual legal form, the proposals are, as they stand, could have unnecessary demutualizations. And it's not extreme to say that the proposals could genuinely destroy businesses which have a long history of responding to their policyholders' needs. National resolution authorities should also be given the authority to support mutual insurer at risk, if necessary, without enforcing change to their mutual legal form. And in addition, they should not be given the power to demutualize a mutual insurer, which is not, to all intents and purposes, a sound ongoing insurer, either directly or as an indirect consequence of their actions. Previously, Amice has been supporting the rapporteur's proposals for an impact assessment for the IRD proposals, which we hoped would provide an opportunity to policymakers to better understand the varied legal forms in the European insurance market, the risks associated with them, and the appropriate calibration of the recovery and resolution-related proposals. And any proposed regulations should be based on the principle of minimum harmonization to allow the national regulations and the national competent authorities to develop solutions accompanied and accommodating the variety of mutual structures in the different European countries. Now, moving on to the second point, how do we turn B into I? B being banking to insurance. So the initial approach to making a wholesale application of the BRD approach and infrastructure failed to recognize the fundamental difference in risk between banking and insurance. Further, it made an incorrect assumption that banking and insurance failure have similar characteristics. It applied the dynamics of banking failures, such as the possibility of a swift run on the bank by customers, leading to swift withdrawal of funds and liquidity challenges, to the proposals for insurers. The reality, which has been fully evidenced, is that there is much longer and more transparent timeline for problems within insurers to develop. And therefore, the emergence of indicators of such allows early responses to prevent them from entering into such territory. This is even more the case for mutual insurers with their long-term perspective and member policyholder engagement. And now the third point is on the need for enhanced proportionality, which we already mentioned earlier, but it's really important that the IRD is implemented in parallel with the Solvency II review as part of the same package. And as you know, the Solvency II review already includes this new definition of low risk profile undertakings. So we do believe that the IRD should include this definition and exempt all entities failing into this definition from the framework. So low-risk profile undertakings, as defined in the Solvency II review, should automatically be descoped from the resolution requirements. This would be a proportionality in action. And then we believe that the framework should also include proportionality measures in relation to the nature of the undertaking. So this could allow for member states to propose for proportionality measures if certain requirements of the directive are not applicable to a mutual as a result of its specific legal form. And then to conclude, we believe that the proposed directive should serve to increase consumer protection and insurers' stability while recognizes the varied legal forms of insurance and offering insurers at risk the opportunity to provide their viable operations. And mutual insurers are ready to work with all stakeholders in the process to ensure that the adopted solutions are fit for purpose and beneficial to the insurance market and all its participants. And thank you for the attention, and I look forward to the rest of the discussions.
Thank you so much, Belma. But before you leave the floor, I'm going to ask you a question. You are from Bulgaria. It surprised me that there are mutuals in Bulgaria, because one of the issues that I have seen when I was at the Commission is that in Central and Eastern Europe in general, the mutual ID is less widespread.
Yeah.
And it was explained to me, but I won't give you the explanation because you probably know it better than I do. But it's interesting to know that in Bulgaria you have a mutual movement. Can you explain where that comes from?
We do have the mutual legal form is recognized by law, but currently there is no mutual operating in Bulgaria. So
we need to do something about that.
We do, yes.
but that's very interesting, because the reason, maybe I should divulge this secret to you, why there are no mutuals in Central and Eastern Europe, or less than in other parts of Europe, it has to do a lot with the belief from people that they don't want to bring things together from the old communist days where they were forced to do it.
Yeah.
They are reluctant to do it again. So that's the answer I've been given. But it's interesting that you have the potential, but not yet the action.
That's correct. Yeah.
Okay.
There's room for improvement.
Room for improvement. Yeah. Thank you so much again, ladies and gentlemen. Let's thank Belma again for her intervention, and let's then move on to the last part of this cinema, of this afternoon, and we have a panel discussion. And I would like to ask to the floor the three members of the panel, to start with Gunnar Hökmark, former Swedish MEP, and as I understand, not retired at all, very active again in different positions. Then Hanna Wallander, who represents Forena, the trade unions, is also very active, as I learned yesterday, even on the European front. And from...
I remember you.
We were good friends, yes, in the good old days. But and now we talk about a different topic. But you're here particularly because you were the rapporteur on the IRRD. And as you could see from the reactions from many people don't necessarily like the IRRD, at least not when it's going to be applied to the insurance sector. Can you tell us a little bit about your experience with the IRRD, and do you share this view that's been expressed here, because you are now also active in the insurance sector, that one really needs to make a distinction between insurance and banking in this area?
Absolutely. Just to be transparent, but I would also like to say it with some proudness. I'm vice chair of Dina Försäkringar AB, which is even older than Länsförsäkringar, but even smaller as well. but it's a good thing that to have you here, because I remember when we discussed Solvency II, we underlined the need for proportionality, which I must say never came into reality. And that's make me say that Solvency II is rather good for us, but maybe not as good as it should have been. I say this because the European politics is very much, I would say, haunted by politeness. And now I feel like an enfant terrible here, because all people here have been so polite and saying that maybe we could change, etc. I think IRRD is the wrong approach. I was responsible, and I did change the IRRD very much, as you might remember, from the original proposal. And I even managed to change Parliament's view on how to keep. From the beginning, it was said that it was absolutely forbidden or prohibited for governments to intervene in a banking crisis, which would have, if that had been reality, it would have had terrible consequences later on. but we stated that first of all, shareholders and senior investors need to pay, and then we can deal with it. And this was very much because banks are, besides you can have mismanaged banks, that's one thing. But normally banks are in a problem when you have a macroeconomic crisis. And then you can never avoid the risk that some of the weaker are more exposed for the problems than others. And the difference between banks and insurance companies are that the same applies not to insurance companies. They are not as much exposed or a project for a macroeconomic crisis as banks are. And I would say that this IRRD is in some way trying to have the same devices for a galloping horse as for walking with a cow. I'm not comparing insurance companies to cows and not banks to horses, but I'm trying to make a metaphor about that. So I would say that I think the right approach, I think is the wrong approach, and the right approach now should be to ask for Commission to withdraw the proposal and do a better work. Maybe developing Solvency II and see to what are the real problems. Because my impression and my understanding is that this IRD is creating more problems than it hopefully could solve. It would hinder new entrants in a time where I think it could be quite thrilling to see new entrants in a digitalized world where companies not only are digital, but the products will become digital. And hindering. And it would also create problems with a level playing field, because if you do exceptions for mutuals, then it will be a problem for the limited companies, and that would in the end not be good. So I think it should be withdrawn as it was with the banking structure reform, if you remember. I'm not sure if you're still angry on me with that, but that was the case.
Yes, but you have a lot of experience in the European Parliament. Do you think that this is a realistic proposition at this far stage? I mean, the Council has come up with a position, and I should maybe remind the audience that in the Council there was a lot of opposition against this proposal also, but nevertheless the Czechs managed to have a compromise proposal. So do you think that's realistic?
That is very much because everyone is so eager to reach consensual solutions, and consensual solutions are sometimes not very good solutions. And we had the same situation with the banking structure reform, because Council was united and very much opposed, but still united. And then in Parliament, I managed to have a majority that in the reality stopped the process, and after some years, the proposal was withdrawn. Yeah. And no one has asked for it to come back.
Yeah. So basically your argument is the IRRD, because it follows too much the example of the BRRD, is not right, and we need to do something else. But do you believe?
First of all, we need to define what do we need to do.
Okay.
I mean,
I
don't say we need to do something. Define first of all what do we need to do. So to say, to challenge you, Carl, what was the problem with Solvency II?
Well, the problem with Solvency II was very clear, that by only looking at underwriting risk, insurance risk, we had insurance companies in Europe that were selling life policies with fixed guarantees, which were way above the market rate, because they could do that because the solvency margin did not take account of interest rate and market risk.
Then my humble proposal is deal with that problem.
That's what we did, yes. but to continue, because this is a very important issue that you're raising here. There's many arguments that have been advanced why we need the IRD, and one of the arguments is, and I know that you disagree with that, is the ESRB says we could have a systemic risk following up from the insolvency of an insurer. The point that EIOPA has underlining quite often is the cross-border aspects. If you have an insurer that operates cross-border, you need to have an organized way of dealing with a situation like that. Would you agree with that?
I can agree with that. Yeah, on a single market, on a common market, you need to have common rules for how to deal with companies that are common. But that doesn't necessarily say that you need to have still another legislation, because then you're plotting things above everything, and in reality you are creating regulatory problems where the one thing is in some way counterproductive to the other. Yeah. I think the right approach would be to define. You mentioned one problem, to define some other problems, and then see what do we need to do with Solvency II, and what can we do with Solvency II in the same way as making it maybe a little bit more. We can learn from what I would say a little bit of the unnecessary bureaucracy it's also shaped, to streamline it a little bit more and see to that it can deal with the fact that we are operating on an internal market. That's another approach, and that's, I would say, a much wiser approach. Now we are trying to, banks are in some way, the business idea of banks are to have deposited money and then lend more money out in a multiplicatory way. That is not the fundamental business idea of insurance companies. It's really more or less the opposite. And in some way, even insurance companies with limited corporations are in some way mutual, because they need to have the reserves that are covering the insurances. So it is very different animals living in very different forests. And that's why I say it is the wrong approach. And I think that people need to be a little bit more unpolite. Not saying, now we have this on the table. Why not take it away from the table?
If I can take you back to the Bank Recovery and Resolution Directive, do you think, having been the rapporteur, that after the changes, it worked well? Because it was also new. Recovery plans, resolution plans and tools, and you hear sometimes the bankers saying all these plans and we have to revise them all the time. There's a lot of bureaucracy. And can you say something about, have you heard or seen this implemented in practice?
Yes, but my view is that in general it has been very well accepted, not least because we did some changes, and we did also some changes from the original proposal regarding BRRD 2. Yeah. And we streamlined it, and we made it more consistent with how business ideas are. But the problem, not the problem, but what I have said many times, that when we had BRD in place, which is clarifying the risks for shareholders and for senior investors, forcing every bank to be credible regarding its levels of capital in order to be able to finance themselves. Just as a thought, it could have been enough with this legislation, because if so, you really shouldn't need the CRRD, because the market would force you to have the right levels of capital. Now, I'm not advocating this, because that would be an impossible case.
You're dreaming.
No, I never dream. I work with reality. But just as a thought or a reminder how you could proceed. And regarding insurance sector, I think we should regulate insurance in insurance sector, not banks in insurance sector. And that's the wrong approach with this proposal.
Okay. I think the message is very clear.
I hope so.
Well, I think it's absolutely clear. And I'm going to move now, leave you a little bit quiet, to give the floor to Hannah, to explain a little bit what is there so special to work in a mutual insurance company?
Yes, I just have to comment then Gunnar first, because I know that Jessica actually had the idea about withdrawing the, thoughts about the proposal, and was really engaged in advocating this. But, you know, at the same time, you have to go into the processes of EU, and I think so that's now we have a proposal. But coming back to your question about the employees, is it a special meaning for our employees working in mutual? And I think we've heard already from both Lars and Ylva today, and these companies are really collaborative and inclusive, and it's part of their soul and business. And Farina, which I represent, we are around 13,000 members, and more than 19,000 actually works in mutual companies. So, and we organize employees in all different areas within these companies, underwriters, claim officers. So a majority of our members are actually giving their time and skills and knowledge and everyday working life into these companies.
Can you use the mic? Yes, so.
Okay. And also our collective agreements cover, in principle, all employees in the Swedish mutuals, since they, as we've heard already, historically actually have very well trade union organized companies. So, and furthermore, these corporate structures, especially in Sweden, are still and to a wide extent co-managed and owned by social partners. And that means that both Swedish employers' organization and trade unions, among all the sectors, not only insurance, are engaged in the operations of mutual models. And that's very special to Sweden compared to all other European countries, I would say. And in the mutual, which is clear by its name, policyholders and employees, as well as employers and businesses join together. So what I know, and I would say from our members, is sort of a higher cause and, being employed in a mutual company. Yeah.
So in sum, what I could say is an employee of a mutual insurance company is proud
yes,
to be
exactly.
an employee.
Absolutely. And I think also because the primary focus is insurance coverage and consumer-friendly services that actually meet the needs of the policyholders rather than just maximizing the shareholders, the profits for the shareholders. So it's a difference to the limited companies, yes.
Okay, why are you then worried about the IRRD? How could that affect the employees?
I mean, as I said, 65% of our members actually work in these companies. So, and if it's, implemented in its present form, we are, of course, worried of job losses. So that's, absolutely one of the reasons. Another reason is if, as Lars also mentioned, Länsförsäkringar is 23 or 25 companies all over Sweden, and Sweden is a huge country. It's long distances, and this is an important player for the regional labor market as well.
So you believe that the IRRD, if it is implemented, could create insolvencies or disappearance of mutuals? That's basically what you're saying?
We don't know, but of course, that's the reason why we as a trade union are engaged in this proposal, absolutely.
Okay, so you basically say, we are employees of the mutual, they have a problem, we go with them because we want this problem to be resolved.
And the employees are also owners and policyholders as well, of course.
Okay, so they are employees, policyholders and owners.
They have different roles, absolutely.
Excellent, yes, very good. Okay. Thank you so much. Maybe a question that I would also ask you, because you are a member, if I'm not mistaken, you're a member of the stakeholder group in EIOPA.
No, I'm not.
You're not?
No.
Okay, then I won't ask you the question.
Yes, actually, I have a colleague here.
Yeah, he's there, yes.
He's
there,
in the stakeholder group.
Good, but let's move on to Insurance Sweden. And Jonas, well, Insurance Sweden represents obviously the whole European insurance industry, and when it is difficult to agree on a position in one member state, it is even more difficult to agree on a position in the European Union, even among insurers. Now, you've seen the Council's position on the IRRD. What's your reaction to that? Are you happy, unhappy, mildly happy, full of hope?
I just hope that they have listened more to Gunnar and withdraw the whole proposal from the beginning. That because there are numerous of concerns with this from a Swedish perspective, at least.
Yes.
We have talked about the mutuals, and Johan and his colleague have done a good job to get in the possibility to adapt resolution tools to mutuals. But there are other problems as well. One thing that also was dealt with to some extent by the council was the problem with those insurance companies or insurance groups and conglomerates with both horses and cows, with both insurance and banks, and that then can be covered by both the BRRD and the IRRD, and that could be some kind of conflict that the Commission didn't recognize at all in the proposal. Now it's somewhat dealt with by in the Council general approach, at least saying that the authorities should talk with each other. I don't know if that solves everything, but at least it's a good step that they recognize that there could be some problems. I think for us, the biggest issue, the biggest problem with the Council general approach is resolution financing arrangements, that you introduce such a requirement that you have to have that in all the member states. And you heard Markus Ferber, he didn't understand why. Here you have it, and you know who's going to pay for it in the end. It's going to be the policy holders with increased premiums and so on. And it's a little bit strange because it's going to be used to compensate policyholders in a failing insurance company, but also the shareholders in a failing insurance companies. And I don't see why does the council care so much about shareholders of failing insurance companies. That's something I don't understand. And if you look back to it was not in the Commission's original proposal because they didn't think it was proportionate to have this.
Exactly.
So there's no analysis of the consequences done by either the Commission or Europa of what would be the effect of having this resolution financing arrangement. And we see especially no clear benefit from the financial stability perspective, but not very limited for the policyholders as well. And of course, as they also have to pay for this, and the cost could be quite high actually, because in the Council general approach, there's no limitation how it could be used. It could also be used for covering the losses of the failing insurance company and the recapitalization of a failing insurance company. We also see in the discussion within the European Parliament that they are talking about pre-funding this. So we get a resolution fund also for the insurance companies, and that's something that we are very concerned about and working strongly against.
Was the position of Insurance Sweden different from that of Insurance Europe? Are there any, or to ask it differently, we have been discussing the particularities of the mutual sector. Was this also one element that you brought into the broader European discussion?
Yeah, of course. But you have to be frank that we have a little bit different background. We come from because in Sweden we don't see a need for it. We don't have it. We don't have anything similar. You have like France, you have the Netherlands. They have something quite similar already. So they are not that as negative as we are. They see that it could be a need for it to some extent, but I think that we are so we have more or less the same view, but I think that we are more negative to the idea of IRD than some other countries.
And what could be the impact of if the IRD were adopted, let's say, in the way the council document looks like now? What would be the impact, do you think, on Sweden?
Yeah, I think one thing we have already touched on, the costs. It's not just the resolution financing arrangements, it's also the recovery and resolution planning. That will be quite administrative burden on the insurance companies that they have to take care of all this, and also that we have to finance a new authority. The industry is financing the supervisory authority, and now they have to also financing probably the resolution authority that will be of IRRD, and as I said, there's no strong protection from. We don't see that this will have any positive effect for the policyholders, mostly cost for the policyholders in terms of high premiums. And one thing that is also a little bit strange in the general approach by the council is the possibility to convert claims into share or equities of a failing insurance company. So that could be the case that your house is burnt down, and you're lucky that the insurance company that you have is having problems and failing, and instead of getting money, you get equities of the failing insurance companies. I don't know how that helps you to rebuild the house, but so there's very strange things going on within the IRRD. I have to say that, and for us, I think that we have been mostly concerned about what the insurance companies have to do in good times. When they have a very strong financial position, as Länsförsäkringar and Folksam, they have already started preparing for a crisis and not just recovering, also the resolution. And that would be very tough and very, very strict and very much work to do that, even if it's going to be the resolution authority that does that work, but they're going to come back to the insurance company and ask for more and more information and have and they will have quite far-reaching powers as well. And how big the cost will be, it's a lot about in the details, I have to say. One such of things that we haven't discussed is what is a critical function of an insurance company. That is very unclear. It's something that we can all agree on, that the insurance companies are very important. But are they critical in that sense? And now in the latest Council General approach, it's going to be that every insurance company with a critical function have to have a resolution plan. Yeah. And we can see from France that have something quite similar to IRRD. They have translated the critical function into critical insurance products. And one of those critical insurance products in France that they identified is unit-linked products. And that would mean that all Swedish life insurance companies would have to have resolution plans, more or less. And so that is something that we can see. And also that we talk about that IRRD must be proportionate. One thing that is where we can see it's not proportionate is the requirement of market coverage for recovery and resolution plans. Because if you, in the Commission's proposal, you have to have a market coverage of either 70 or 80%, depending on the resolution and recovery plan. And if you look at how the size of those companies that you have in France or Germany to come up to those 70 and 80% and compare it to the Swedish companies. I've heard that in France, the companies that they have today having resolution plans, they have assets above 50 billion euros. And if you look in Sweden, a few of them have, but many of them that we have to come up to those market coverage don't have those, are not even close to those kind of figures. And if we are thinking that our companies are small that have to have the recovery resolution plan, look at the Baltics, for example. So how can you say that it's proportionate when you have those kind of requirements? And that will, of course, change the competitiveness between different markets, because there will be different type of companies, different size of those companies that have to have recovery and resolution plans according to IRRD.
But that is obviously unavoidable. Whenever at European level you set a percentage of a market or so, as the markets are different, you have different consequences. The same thing, the discussion we've had now in a Solvency II review about what is a low risk profile undertaking. Oh, there's a nightmare to decide what it. We know what it is, but we can't define it because there's so many differences between the member states. But to pursue you, I mean, you hold strong views on this issue. What's your message now to the co-legislators? I mean, with the council with this position, the parliament is still not exactly knowing which direction to go. What would be your message?
Still go back to the drawing board and do this work. I think that one thing that should be reasonable to have is to have a more strict requirement of a recovery plan in the OSHA. We have already talked that it's already included, but you can have strict requirements as is proposed for the climate risk scenarios in the current review of the Solvency II. So you can have something similar. You don't have to have the resolution, especially resolution planning and those kind of steps. That's not necessary. But it's wishful thinking. I know where we are in the negotiation. I think that flexibility, that's the key. And one thing is that I mentioned already, delete the market coverage. That's not that limits the possibility of flexibility. And I think the flexibility is needed not only for mutual. I think it's because there's so many consequences of this, and it's been so hard to see through, and it's been quite. The negotiation within the council went very quick. I have to say, when you're considering how complex this regulation is, so there could be other consequences for other companies as well. So we will see that you should be a possibility to adapt the regulation to all types of businesses and all types of national features, for example, insurance products, so it works for everybody. I think that is something that is really important. And of course, not introduce resolution financing arrangements or IGS or something like that.
Okay, well, that's very clear. Gunnar.
One reflection, and that is that now we are talking about insurance companies. But if we talk about insurance markets and financial markets, we can also get another perspective, and that is, the Swedish insurance market is compared to most other European markets, extremely well functioning. You have the Big Four, which were 20 years ago very much the Big Four and very dominating, but they have got much more competition. And today I think we are in the top regarding how much money that goes back to the customers compared to the premium. And this would hurt that because that would undermine especially the smaller ones and the new entrants. And that would, in that sense, undermine the level of competition we have. But if you look one step further, a dominant call for change in the European Union is to achieve a capital markets union. And I think insurance companies are an extremely part of the ecological environment of a capital market. Banks are, insurance are, and then we have private equity and venture capital and all other things. But if you are squeezing a very fundamental sector, which the insurance sector is, then you're squeezing the opportunities for the capital markets union. You might have union and you might have a lot of regulations, but you will have less capital. And that was in some way the idea, to have more capital. And I think that you need to tread carefully. You mentioned that now it is on the table. Well, banking structure reform was on the table for quite a long time. But strong wills hindered a final solution in Parliament, so it never came to the trialogue you mentioned. And in the end, the legislation was frozen and withdrawn. And that is, I sometimes point to that as one of my main achievements, but it is never recorded because it was never a real legislation. It's very unfair. But I can live with it.
Yeah. But would you agree? I'm trying to find a compromise, because life is a big compromise. and also in this.
No,
this
not
area.
not always.
No.
Sometimes
Tell me.
life is that you need to take decisions.
Yeah. Yes. But in taking those decisions, my experience at my old age is that you always have to take compromises if you want to survive. If you take the decision and you take only account of yourself, then you get killed or you commit suicide or something like that. It's not going to work. But so if I understand you correctly, and maybe for the three members of the panel, you would agree that the present situation where we have a Solvency II, which we agree works well, that the element of dealing with a crisis can be improved because Solvency II doesn't really deal in detail with that. So there is a need maybe to be a little bit more specific about what should be done, how this should be dealt with. But your message is not in the way it's done now in the IRRD, but something needs to be done. You would agree with that, Anna?
Yeah, I would just say that, I mean, I agree with all the panel that the proposal need to be more flexible. Yeah, and what it should reflect is the mutual undertakings in a better way and give the policyholders protection, and that need to be done independent of the legal form. Yeah, that's our message to the co-legislators.
Okay, so to save the house,
yes,
because it seems to be burning,
yeah,
flexibility.
And I think
might be a
it's, I
solution.
mean, now the process has gone so far, so I mean, having these conversation and we can have other ideas about how we should do, but I think it's now gone very far in the process. So we need to keep on and, keep on our work that we've already done during actually a whole year together. And the collaboration we've had with Länsförsäkringar and Folksam has been a very, very, very important, I think.
Okay.
Just to come back a little bit, I think that we have, of course, Solvency II is not dealing completely how you should do with a failing insurance company, but we have national law for dealing with bankruptcies, and you can use the same regulation, and you use the same regulation nowadays in Sweden, whether it's an insurance company or another company, and we have done it in Sweden, and it's been working well. And there's no evidence that the current system that we have in Sweden is not enough, is not sufficient with dealing with failing Swedish insurance companies. So that's why, if you cannot show why it's needed for a Swedish perspective, that's why we are so strongly against, because there's no evidence. It could be so in other countries, but they could adjust their national regulation and not impose it on Sweden as well.
Well, that may not be the case in all member states,
Yep.
that's for sure. But the question is, or the fact is, that EIOPA was strongly in favor of this reform. I don't think that EIOPA specifically proposed to use the BRRD as a kind of a framework. I haven't seen that, but EIOPA did present a very detailed framework for crisis prevention in insurance, which means that the supervisors may not share the view that things are working well, and they are complex by definition.
Yeah. But my view is that supervisors and authorities always want more. More of that and more of that. And that is not wrong of them, because they want to enhance their security. But that might necessarily not be what is the right thing. But first of all, I think you should get rid of some of the things that are really bad. For example, resolution fund, etc. And then second, you could see can we solve this in a way that member states who claim that they have a sufficient legislation already can be given some sort of exception if they can prove that these issues can be dealt with in the framework of present legislation. That could be done. Or, as I said, I mean, the jury is still out. If the parliament doesn't come to a solution that is united, the thing will... You can go with a can along the street and then you can wait what will happen. But I don't think you should feel that this is a thing that is necessary to act fast. But because one reflection I have made during this discussion, but also listening to others in Europe, there is no one who says that this is an acute thing. No one regarding banking resolution. It was seen to be an acute.
It was, yes.
And that's a very big difference.
In banking, as we received recently, that in the United States and in Switzerland, where we had a major banking crisis, nobody looked at the legislation. Action was taken immediately overnight in a direction that came as a complete surprise, always in order to avoid financial instability and a crisis and a run on the banks. The solution found in Switzerland was quite remarkable, astonishing. It was probably the only possible way to do it. But clearly the books would not have said, do it this way, because the systemic risk was increased exponentially. Yes. And also in the United States, where they have this system of deposit guarantee protection, they should ignore it. Everybody's protected. It reminds me a little bit of the financial crisis, which to some extent started on that base. But I think, ladies and gentlemen, we have probably used your patience enough. I don't think there's anybody in this room that can say, I do not know anything about recovery and resolution in insurance. I think we have elevated the knowledge of everybody in the room. We've seen the controversies. It's fair to say, and in the beginning of the negotiations, it was like that. In the council, some said we like it, some said we don't like it, some said we don't know whether we like it. And we're still in a situation where there clearly is still a lot of nervosity. The message that comes out of this is, I interpret it, Europe needs to recognize that not everything is the same. And Europe needs to recognize it's not good to do as if everything is the same. And Europe should also make sure that they don't make everything the same. So that we recognize rightly diversity and that some flexibility in regulation is necessary, always with the hope that the people then that will apply whatever rules there are will do so within the spirit of making sure that when it is insurance, that policyholders are protected, because that's the obvious goal of insurance regulation supervision. But ladies and gentlemen, let's thank the panel for the contributions, very clear. And I give the floor back to Klaas.
Thank you. This time I remember to use the microphone. Dear Karel, thanks a lot for a very proficient guiding through this misty waters. What do you say?
Muddy.
Muddy waters. I learned a lot, starting from knowing nothing. Now I know much more about the insurance business and the challenges that you have with this proposed directive. And with that, I would like to thank you, Karel, and all the other participants in this debate, and of course the audience as well. And now we have the possibility to meet each other during more informal ways on the floor 1.5, which is one escalator down. So thanks to all of you. Thanks to Folksam, thanks to Forena, thanks to Länsförsäkringar, and thanks to Amici for cooperating on this seminar. So thanks a lot and welcome.